Hey there, my name is Robert Reynolds, and in today's video we're going to be analyzing different ways in which we can understand the risk profile of an asset. We're going to be analyzing beta and or squared. Beta gives us an idea of the volatility of an asset, and that can give us more of an idea into the systemic risk for reasons that we'll mention a little bit later in today's update, as well as inputs into the capital asset pricing model in order to better understand what the expected return of an asset is. Or squared will give us an idea of what the market risk we're taking on by owning an individual company. Is the correlation very high to the overall market, or is it very low? Ideally, we would like to be in search of uncorrelated returns. So without further ado, let's get straight into it. So first things first, let's understand what beta tells us. Secondly, let's understand how we can use beta as an investor. And third, we're going to go through an example where I show you guys how to calculate it. Very simple stuff. Okay, what is beta? As you can see here, I've got a little bit of a diagram, hand-drawn diagram. In the middle there, we've got the market. Let's just assume that the market is the S&P 500. The market always has a beta of 1. And in this example, as you can see, this green line here would closely follow the S&P 500 or the market, but it's slightly less volatile. That might have a beta of 0.9, and then you can see this red line here, which is very volatile. It's all over the place. It's very volatile. That might have a beta of 2. So what exactly is beta? Beta is more a measure of volatility of one individual asset or one individual company's stock price relative to the market. And the idea behind it would be this here, for every 1% move in, let's say, the S&P 500, company A will be expected to move roughly 2%. So beta is telling us what the volatility of one individual asset is relative to the market. A beta below 1 would mean it's less volatile. So if we were to see the market move 1% on the upside, we would expect the company B would move 0.9% on the upside. If we were to see the market move down 1%, we would expect that company B would move down 0.9%. So what we can learn from this and understanding about individual companies is when and where we should be long maybe high beta versus short beta. At the very beginning of a bull market, where the market's more inclined to increase more often than it decreases, we would want to be long high beta. Why? Because for every 1% move on the upside, we'd be expecting 2% move in these companies. As we get towards the end of the cycle, aggregate demand starts to slow down, unemployment starts to increase, and we start heading towards a recession, it's more ideal to swap out high beta for low beta. Why? Well, for every 1% move that the market goes down, we're expecting a potential loss of 0.9%. So in the earlier stages of a bull market, possibly owning higher volatile assets, depending you've done your homework on it, might be more beneficial, and towards the end of the cycle, owning companies with a beta that is below the market, again, might be beneficial to preserve capital. So how can we use beta? There's 3 different ways in which we can use it outside of what we just mentioned, beginning and end of a cycle. The first way is understanding systemic risk. Now, volatility is not necessarily risk. However, let's say you analyze the company and they've got a terrible, terrible balance sheet, and they also happen to have a beta of 2. We roll over, aggregate demand rolls over, the company's running out of cash. It's necessary to raise cash, but why would it be systemic risk? They may be raising cash at precisely the wrong moment. So this diagram here would be price relative to time. And as you can see here, as we start to slow down, high beta would slow down at a faster pace. If you haven't done your homework on the company, you're stuck in a high beta asset, and you're at cycle troughs, and this company needs to raise some cash, it could impose massive systemic risk. However, if the company has a solid balance sheet, it's in a growing and stable long-term market, it just so happens to be that it's cyclical, high beta could actually be a massive opportunity because of the volatility. So there's 2 different ways of looking at it. Be very careful with the systemic risk factor, and it's very important that you understand the financial statements. Understand the balance sheet, understand the income statement, understand the cash flow statement before you get into a company that has a high beta. There's nothing wrong with owning high beta, but just know what you own first. Secondly, how could we use beta in order to build out a portfolio and manage those peaks and troughs, all that volatility that we'd see in a portfolio? If we can't stomach these type of performances, and we want to sort of balance the volatility in the portfolio, we might be making a mixture of good quality, high beta companies and low beta companies. And what we might end up doing is using beta to understand how much capital we want to invest in the low beta company versus the high beta company in order to balance that volatility. Again, there's nothing wrong with owning high beta stocks. However, if you balance that volatility in the portfolio, it should get you closer to market returns. And then if you come out the other side into a new bull market, you might be able to benefit. So what we can do is, in this example, company A has a beta of 2, company B has a beta of 0.9. How much capital, let's say we had $100 and we have a 2 company portfolio, how much of that $100 should go to the high beta company and how much should go to the low beta company? What we do know for sure is, because there's higher volatility with the company that has a beta of 2, we would want to have less capital with company A versus company B. So what we can do is we can take 0.9 and divide it by 2 plus 0.9, and that'll give us 31% of our $100 would go towards the high beta company. How I came to that conclusion is taking the beta of the second company and dividing it by the total added beta together. Gives me 31% for low beta, 68.97% for the high beta company. And that's essentially how we could use beta to normalize the volatility in the portfolio to reduce systemic risk. And then finally, beta is used in different models such as the capital asset pricing model to understand what the expected return is or the opportunity cost. So that's the background on beta, what we can use it for, and essentially what it is. Now we're going to understand how we calculate beta. For this, we need to download the share price of the individual company which we want to analyze the beta for and the market. We're going to use the S&P 500 for that. It's really, really important to note that when we go to websites such as Yahoo Finance, they will display the beta for us. So we don't necessarily have to calculate it ourselves. We can take the 5-year beta here. However, in certain circumstances, we may not have the luxury of finding that beta, maybe because there's not a long enough sample size, for example. In this case, this is the 5-year monthly beta. What we're going to do is we're going to analyze the beta of Apple, not on a monthly basis, but a daily basis to get a little bit more concise view. We're going to go to historical data, and we're going to go over here to time periods. We're going to get the last 5 years, and we're going to apply that data. And then we're going to click download, and we're going to get it in an Excel spreadsheet. As well as that, we're also going to download SPY. SPY is the tracker fund that tracks the S&P 500. We're going to go to historical data. We're going to go to time period, 5 years, apply, and download. When we open the Excel spreadsheet, it's going to look something like this. All we need is the adjusted close. So we're going to delete all this, and we're going to leave it with the adjusted close. And this is for Apple. So I'm going to change that to AAPL, Apple. We're going to do exactly the same for our SPY. So we're going to take this, the close, and the volume, and we're going to delete all of this. We're going to change this to SPY, and then we're going to take both of these, Control C, copy it, and we're going to put it into our other spreadsheet, right beside Apple. As you can see here, we can see that the dates match up. So I'm going to delete this date column. We don't need it. And what we're going to do is, I'm going to click on date, go to data at the top of Excel, filter, and I'm going to go to the newest date. And what we're going to do to calculate returns is, we're going to key in a very simple formula, equals, open brackets. We want the difference between today's price and yesterday's price, and we want to divide it by yesterday's price in order to get the percentage change. Drag that across, and then there's a little square at the bottom right hand corner. We're going to double click that. We're going to change it to percentage. We go back home. We're going to change it to percentage. There are the daily percentage moves. We'll move the decimal place a little bit over. We're going to put in front of this or AAPL for returns, and we're going to put in front of this or SPY. Now at the very bottom of the page, what you'll see is there's an error. So we've got to get rid of this error here because there's no data here, so we need to make sure that we get rid of that. Now what we want to do is we want to understand what beta actually is. So a moment ago I told you the theory behind beta, but beta is essentially calculating the slope of the line. So what we're going to do now is we're going to highlight the D column and the E column. we're going to go up to Insert, Scatter Plot, and we're going to put in a scatter plot here to better understand what beta actually is. So we understand in theory what it is. It's a measure of volatility, but it's measuring the slope of the line. So if I click on one of these dots here and I right click, I add a trend line. So I want a linear line. I'm going to change that to red so it's easier to see. And as well as that, I want to add in the R squared, which I'm going to explain to you what that is in just a moment. Slightly different to beta, but it can also give us an idea of how much market risk we're taking on. So beta is essentially measuring the volatility of one asset relative to the market, and that's the slope of this line, whereas R squared is calculating the correlation between one asset and the market. The higher that correlation is, the higher we have what's known as market risk. You don't have uncorrelated returns. So in this case, you can see that the R squared is coming in at 0.6348, which is 63.48% correlation with the S&P 500. It's quite high. It's one of the largest components, so it should be easy to understand why the correlation is quite high. So beta is measuring the slope of this line, and what R squared would mean is, if that was 100% or 1, we would see all of these dots line up along this line here. So the R squared gives us an idea of the market risk that we're assuming. We're not getting uncorrelated returns, and the beta is going to give us an idea of what the volatility is. Now beta is essentially a regression analysis. So what we're going to do now is we're going to go up to data. We're going to go across to data analysis. We're going to look for regression analysis. There's regression. We're going to hit OK. Input Y should be the individual company, the stock returns. So that's Apple. We go Control, Shift, down. And then for input X, we want market returns. So we go back up to the top here. We want market returns. Control, Shift, down. And then the output range, we are going to put this in. Click on that. We're going to essentially build in the data right there. So what your beta is here from this regression analysis is your coefficient. The X variable 1 is essentially what your beta is. It's pretty close to what we've seen on Yahoo Finance. They had 1.25. This is coming in, if you round it off, 1.24. But the difference is Yahoo Finance are looking at it on a monthly basis. We're looking at it on a daily basis. So there's going to be a slight variation there, but it's coming in fairly close. The beta of Apple, according to our analysis, is 1.237710738. And up here on the regression analysis, we also have an R squared, which comes in exactly the same as the R squared we got over here. So again, what this essentially means is that for every 1% move that we see in the S&P 500, we would see roughly 1.24% move on the upside or the downside for Apple. There is also an easier way to do this. You don't have to do a regression analysis. You can just use the slope function. Equals slope. We want to get the slope of the line, and then it'll tell you here known Y. Always remember that the Y-axis is the stock price. Control Shift down, comma, and then we'll get the X-axis for the market, and that should give us the same results. 1.237710738. So that's essentially what the beta is of Apple. And again, going back over to our whiteboard here, what we can use that to understand is how big maybe a position size is likely to be in a portfolio, the systemic risk. 1.24% is likely the average movement for every 1% move in the S&P 500. And then finally, we can use it in models such as the capital asset pricing model to better understand what the cost of equity is or the opportunity cost of an individual company. If you're interested, we also cover the weighted average cost of capital here on the channel, where beta is an input into that model. And we also cover the balance sheet to make sure that the company is solid, just in case you're considering a high beta asset. Thank you very much for your support and have a great day.